Our first qualitative characteristic is relevance. Try and remember as we go which goes in which category. Relevance has several accounting principles that actually are quite similar and confirm relevance, but do remember that it is a qualitative characteristic. Let's come up with a definition. Relevance is all to do with decision making. Any piece of financial information is relevant if it will influence your decision making by either helping you evaluate a past, present, or future decision, and confirming or correcting a past decision. So if a particular piece of information is going to help you make a better decision or impact your decision making at all, it is therefore relevant. There's two ways to tell whether something is relevant. One is the materiality test. Something is material and should be included in financial reports if it's large enough to influence your decision making, or if you omitted it or misstated it, you'd actually get a bad decision. Let's look at a couple of examples. Let's say you're doing the balance sheet for your business and you left out a $250 FPOS machine. Is that a material item? It depends on the size of the business. If it's a very small store on the local high street, like a little shoe store, you could probably argue that is a material item and it should be included in the financial reports. That's a business that might only have assets in the hundreds or maybe thousands of dollars. So leaving out something worth $250 is quite significant and would probably affect your decision making negatively if you left it out. What about for BHP Billiton, a business that has assets in the hundreds of billions of dollars? Well, if you didn't include a $250 asset, you're not going to make a worse decision. It's not a material item. Omitting it won't affect your decision making. Using a larger item, a $50,000 van, the amount obviously is much higher than the $250 FPOS machine. So for the local store on the high street, absolutely that's a material item. That's probably going to be their biggest asset, depending on whether they own their property. For BHP Billiton, should that item be included in the balance sheet? Absolutely it should. What we're talking about is if you forgot it or misstated it, you listed it at the wrong amount, would it result in bad decisions being made? I wouldn't have thought so. Given that BHP Billiton has hundreds of billions of dollars of assets, one $50,000 van either left out or listed at the wrong amount won't affect your decision making. Let's have a look at another example. Let's pretend these are the assets of BHP Billiton. You've got cash at $54 million, debtors at $29 million, inventory at $115 million. Do we need the cents? Is having them in there helping us make a better decision? Could we leave them out? I think you could argue that if we just took out the cents on those three items, that's not going to affect our decision making. The cents aren't relevant for our decision making. Let's go a step further. Why don't we just express those numbers instead of in full? Why don't we just abbreviate them to the nearest thousands of dollars? So cash could be expressed as 54,690,000, which is actually 54 million, and the other two could be listed the same. And in reality, you could actually go one step further. Most businesses at this level list their assets in the millions of dollars. Why don't we just actually abbreviate everything to its closest millionth? That way, we're actually going to have easier information to read. And look, leaving out those last few digits of each number, is it going to affect our decision making? I don't think so. I think having that information on the right is just as good as on the left. And in fact, it's probably better because it's simpler to read. The other test we've got to tell whether something is relevant is the entity test. First of all, is the transaction one that's personal for the owner? And if it is, that's not a business transaction. And what if the owner actually owns multiple businesses? You need to establish which transaction relates to which business. Using an example, let's pretend Mary owns ABC Company. They are separate entities. You can see Mary's on the left in blue, ABC Co.'s on the right in grey. Mary's personally wealthy and owns $2 million in property. They're her personal assets. She wants to expand the operations of ABC Co. by going to the bank and asking for a $500,000 loan for ABC Co. To make ABC Co.'s application look better, she lists her property, her personal property, as an asset of the business. Can she do that? Absolutely not. Relevance and the entity principle states that her personal property is not a relevant asset for ABC Co. and therefore it shouldn't impact its decision making. They are separate entities. What about if Mary owns two businesses? She owns ABC Co. and XYZ Limited. ABC Co. has received a $400 phone bill, but they have no money left in their bank account. So what she decides to do is transfer that bill to XYZ Co., which actually has $20,000 cash in the bank. Is she allowed to do that? Absolutely not again. The $400 phone bill, it's just not relevant to the expense, it's not a relevant expense to the decision making of XYZ Co. They are separate entities, and therefore their expenses, their assets, their liabilities, all their financial information should be kept separate.